Every once in a while, history circles back in ways that feel almost impossible until they happen. Right now, we are standing on the edge of something that might very well be remembered for decades as the turning point in global finance. For more than 50 years, we've lived in a world where the US dollar has reigned supreme, backed not by gold, not by anything tangible, but by trust, by political dominance, and by military might. But here's the shocking truth. That trust is eroding. That dominance is slipping. And behind the curtain, central banks and investors with deep pockets are preparing for a monetary reset. People like Adrian and Lobo Tiggre have been warning for years that what's happening right now is not business as usual. This could be the early phase of what many are calling Gold Standard 2.0. Let's go back for a second. Imagine the year is 1971. Richard Nixon steps up and makes the fateful announcement that the United States is suspending the convertibility of the dollar into gold. That single move, known as the Nixon shock, shattered the foundation of the Bretton Woods system. Until that moment, the world had lived with the dollar being as good as gold. 1 ounce equaled $35, and that anchor kept everything balanced. But when Nixon closed that window, the dollar became a pure fiat currency, backed only by promises and political clout. Many cheered the move, saying it gave America more flexibility, but what it really did was set us on a path of endless money printing, ballooning debt, and cycles of boom and bust. Fast forward to today, and we're drowning in that debt. Over $34 trillion in U.S. federal debt, deficits spiraling out of control, and interest payments that are beginning to rival military spending. Think about that. The cost of simply servicing America's debt is now competing with the defense budget. That's not sustainable, and every serious analyst knows it. Adrian put it bluntly. Central banks around the world are no longer willing to hold 70% of their reserves in dollars. That number has dropped below 50% and continues to slide. Why? Because they don't want to be trapped in a system where Washington can weaponize the dollar against them. And here's where gold and silver come in. For centuries, these metals weren't just commodities, they were money. Real money. They couldn't be printed out of thin air. They couldn't be devalued overnight by politicians desperate to win the next election. And slowly but surely, they're making their comeback. In the past few years, central banks have been buying gold at record levels. China, Russia, Turkey, and even smaller nations are quietly stockpiling, while at the same time trimming their U.S. Treasury holdings. It's a silent revolution, but make no mistake, it's happening. Now, Adrian points out something that most mainstream outlets completely ignore. He says this is not about speculation, not about chasing quick profits. The big players are buying gold for one reason: insurance. Insurance against a system they no longer trust. And think about that word, insurance. You don't buy insurance to make money, you buy it to protect yourself when disaster strikes. That's exactly what's happening here. Wealthy families in the Middle East, non-official buyers in China, and institutional investors worldwide are building their fortresses of physical gold. They're preparing for what they see as inevitable: a reset, a crisis, or at the very least a de-dollarization trend that changes the global landscape forever. And silver? Well, silver has always been gold's volatile cousin. When gold moves, silver tends to move further, faster, and more dramatically. Lobo Tiggre has been very vocal about this. If gold is heading toward $4,000, silver could easily blast past $50, maybe even into triple digits if the conditions line up. But silver comes with risk. It's more industrial, more volatile, and often lags until suddenly it doesn't. That's why serious investors usually anchor themselves with gold and then use silver as the turbocharger when the trend turns parabolic. The big question is, are we really heading into a new gold standard? Will the Fed, under mounting pressure, eventually be forced into a system where gold once again plays a direct role in valuing the dollar? Adrian believes we're moving toward what he calls a shadow gold standard. Not a full return where every dollar is redeemable for gold, but a situation where the price of gold serves as a barometer for the dollar's credibility. In other words, gold becomes the silent regulator, the asset that restores some discipline to a system that's been abused for too long. Think about what that means. If confidence in the dollar continues to erode, the Fed's ability to manipulate interest rates, to inflate away debt, and to maintain control weakens. The market itself will force a reset. Investors will no longer tolerate endless devaluation, and they'll flock to hard assets. Gold at $2,000. That's already happening. $3,000 or $4,000? That's where Adrian Day and Lobo Tiggre say things get serious. At those levels, psychology shifts. It's no longer just about hedging, it's about survival. Silver at $50, that would grab headlines across the globe, pulling in retail investors who have ignored the metals for years. But here's the twist. This time, it's not just retail speculation. It's structural. Central banks aren't trading in and out of gold like a stock. They're building reserves for decades. That's why this rally feels different. It's not just a cycle, it's a paradigm shift. And that's exactly why both Adrian Day and Lobo Tiggre stress caution. Not because they doubt the direction, but because when things go parabolic, corrections can be brutal. A dip of $600 in gold or $10 in silver might sound like a crash, but in reality, it would only be a pause in a much larger bull market. Now, imagine for a second what happens if the Fed itself is forced to pivot toward acknowledging gold. Not by choice, but by necessity. As inflation refuses to go quietly as the dollar weakens and as foreign nations reduce their reliance on U.S. debt, the Fed could find itself cornered. To restore credibility, to maintain any shred of trust, they might have to bring gold back into the conversation. That's gold standard 2.0. Not the exact system of the past, but a modern adaptation where gold once again anchors value. And if that day comes, the price of gold and silver won't just rise, they'll be revalued. Let me tell you why this matters to everyday people. If you're holding dollars in a savings account, you're already losing. Inflation is eating away at purchasing power month after month. If you're relying on bonds or treasuries, you're exposed to a market that's losing its largest buyers. And if you're all in on equities, you're exposed to bubbles that pop the moment liquidity dries up. But if you're holding gold and silver, you're holding something timeless, something that central banks themselves are fighting to accumulate. That's the ultimate signal. If the wealthiest and most powerful institutions on Earth are buying, what does that tell you? And here's the reality. The window is closing. Once this trend goes mainstream, once the headlines scream about $4,000 gold or $75 silver, it'll be too late. Retail investors will rush in, prices will spike, and those who prepared early will already be sitting on massive gains. Adrian Day said it clearly. Retail interest is only just beginning. That's the afterburner. The real surge comes when ordinary people wake up and pile in. And the irony of all this is that most people walking down the street have absolutely no idea what's going on. Ask your average person what the Federal Reserve even is, and they'll shrug. Ask them how money is created, and they'll say, well, the government prints it, right? But here's the uncomfortable truth. Money isn't just printed, it's created out of debt. Every time the Fed expands its balance sheet, every time commercial banks issue loans, they're expanding the supply of dollars. It's an endless cycle built on leverage, and as long as trust holds, the system works. But when that trust begins to crack, the entire foundation trembles. And that's exactly what Adrian Day and Lobo Tiggre are pointing out. We're not talking about a small adjustment here. We're not talking about a 5% correction in equities or a temporary dip in the bond market. We're talking about the potential rewriting of the rules of the game. A gold standard 2.0 wouldn't look like the one of the 1940s or even the one before World War I. It would be modern, digital, integrated with central bank digital currencies, and yet at its core it would be tied to something real, something that cannot be conjured up with the click of a mouse. And that's gold. Now, Lobo Tiggre made an excellent point about psychology and markets. Once an asset breaks through major round numbers, it doesn't just move prices, it moves emotions. Gold at $4,000, silver at $50. Those aren't just numbers, they're milestones that ignite fear of missing out. And when FOMO hits the mainstream, it becomes a self-fulfilling prophecy. More buyers push prices higher, which attracts even more buyers until the cycle feeds on itself. That's when things go parabolic, and that's when corrections hit hardest. But unlike speculative bubbles of the past, like dot-com stocks or meme coins, this one is backed by central banks. That changes everything. Consider this. Since late 2022, China has been quietly reporting official purchases of gold, but analysts estimate they're actually buying far more than they disclose. Over 30 tons per month on average. Do you realize how massive that is? Every ton of gold is about $70 million at current prices. Multiply that by 30, then by 12 months, and you begin to see the scale. This isn't retail investors buying a few coins. This is nation-states shifting their reserves in preparation for a new financial order. Russia is doing the same. Turkey, India, and even nations in Africa and South America are following suit. The dollar is being slowly dethroned, not by force, but by quiet accumulation of gold. And here's the kicker. The Fed knows it. They're not blind. They see the same data we do. They know foreign demand for treasuries has collapsed. They know central banks are diversifying. And they know debt levels are spiraling out of control. But their toolkit is limited. Raise interest rates too high, and they trigger a recession or worse, a financial collapse. Cut rates too soon, and inflation roars back. Print more money, and they risk accelerating the dollar's decline. In other words, they're trapped. And that's why people like Adrian say gold is the only way out. The only anchor strong enough to restore some semblance of stability. Now let's talk about silver for a minute. Because while gold gets the spotlight, silver often tells the more dramatic story. Silver is not just a monetary metal, it's also an industrial powerhouse. It's used in solar panels, electronics, medical devices, and now in the technologies driving the green energy transition. Demand is skyrocketing while supply remains constrained. Mines aren't producing enough to keep up, and many silver deposits are byproducts of other mining operations. That means supply can't just be ramped up overnight. So when monetary demand collides with industrial demand, the result is explosive. That's why analysts like Lobo believe silver has the potential to not just hit $50, but to overshoot into triple digits before the cycle is done. But again, the key theme here is structure. This isn't a pump and dump. It's not a temporary mania. This is a global reallocation of wealth. And if you're watching closely, you can see it happening in real time. Look at the flows into ETFs like GLD and SLV. After months of outflows, suddenly billions are flowing back in. Retail interest is waking up, institutions are nibbling, and central banks are doubling down. That's the perfect storm. And think about the timing. Inflation is proving sticky, the economy is slowing, and geopolitical tensions are rising. We've got wars, trade conflicts, sanctions, and a global shift away from unipolar dominance. In times like this, people don't want promises. They want certainty. And the only certainty left is in something that's been trusted for thousands of years as gold and silver. Now here's a thought experiment. Imagine the Fed steps up tomorrow and announces that to restore confidence in the dollar, they're going to peg it to gold. Not fully redeemable, but partially backed. Maybe 10% or 20%. What happens? Immediately, gold would have to be revalued dramatically higher. Because at current levels, there simply isn't enough gold to cover the trillions of dollars in circulation. The math demands a reset. That's how you get scenarios where gold hits $10,000 an ounce or more. It's not speculation, it's arithmetic. And silver, riding shotgun, would follow with a vengeance. This is why Adrian and Lobo Tiggre keep hammering on the same point. Don't wait for the headlines. By the time the mainstream media is telling you gold is hot, by the time your neighbor is bragging about buying silver coins, the easy gains are gone. The smart money moves early, quietly, and decisively. That's what central banks are doing. That's what wealthy families are doing. And that's the message for anyone paying attention right now.